Hello everyone, welcome back to Rise Finance. The market so far this year has been very volatile, with the Fed rate hike news dominating much of January and the geopolitical tensions between Russia and Ukraine taking up much of the news from February onward. The S&P 500 is down almost 11% year to date, with the mega cap stocks taking the major brunt of it. We can see it more evidently played out in the Nasdaq, which has fared much worse year to date. Nasdaq, which was at its all-time high back in November, has fallen almost 20% to fall into the bear market territory. What this correction has done is bring many of the major mega cap companies into a fair value territory. In this video, we'll look at few such stocks and see their current valuation and discuss their expected growth. If you are new here, consider subscribing and hitting that bell so that you don't miss a single video packed with valuable information just like this one. The first in our list is the very well known Apple Inc., ticker symbol AAPL. Apple is the technology king that just knows how to run its business in an efficient way and generate profits year after year. When we look at their financials, we see the numbers steadily increasing for the gross profits year after year. That reflects even in their net income trend being upward and also their dividend share, which keeps steadily increasing. Mind you, Apple doesn't pay a high dividend. It just has a current yield of 0.56%, but that has been growing at a pace of 9.07% over the last 5 years. By the September of this year, Apple would have paid out dividends for the 10 consecutive years, and that would make it eligible for many other ETFs and mutual funds, which consider a 10-year timeline for the companies to pay out their dividends. So more institutional money is expected to pour into the company, thereby increasing their already high free cash flows. That gives Apple the capability to pay out its dividends and also invest a majority or portion of it back into its product and further research. Apple now has a twice a year product launch cycle, and that allows it to churn out new products the entire year. Apple has fallen almost 12% year to date, and this fall has brought down the PE ratio of Apple to below 26. Apple rarely has its PO so low since the humongous rally that we saw after the pandemic in 2020. So you can see here the PE was always in the higher 30s and mid 30s, and now we see it is at below 27. Per my calculations, that consider the trailing yields and the current yield, and also the future 5-year EPS growth, I see Apple being fairly valued at $160 with an average growth rate of around 15% over the next 5 years. So if you're able to grab any of the Apple stock around the 160 mark, that would really be great. Next on our list is Microsoft, ticker symbol MSFT. Microsoft, as we all know, manufactures computers and software services and is also a major player in the cloud services sector. Microsoft also has taken a big hit year to date, falling almost 18%, but the fundamentals of this company are intact. Here we see the gross profit in a nice upward trend. Likewise is the net income and also the dividend per share. Microsoft also has a low yield of 0.9%, but the 5-year growth rate of 9.49% and a dividend growth of 18 consecutive years makes it a very good growth stock that also pays a little dividend on the side. Microsoft also, like Apple, trades at a high PE of more than 35 frequently, and with the recent dip that we have seen, it has fallen to just over 30, which gives us a nice buying opportunity. Per my calculations, Microsoft has a fair value of $286 and an expected growth of 18% over the next 5 years. So any more dip in the stock price from here on should be a good price point to jump in. The next stock on our list is Accenture PLC, ticker symbol ACN. Accenture is a multinational company that specializes in information technology services and consulting. Accenture has been hit hard in the recent tech downturn, but the fundamentals of this company are intact. Here we see gross profit having a nice good uptick. Likewise, the net income. Accenture has a market matching dividend yield of 1.29% with a 5-year dividend growth rate of 9.88% and has been paying dividends for the last 11 consecutive years. Per my calculations, Accenture's fair value is $309, so the current price point is right around that mark and is expected to grow at 13.5% over the next 5 years. Fourth stock on our list is Mastercard, ticker symbol MA. Mastercard is behind most of our credit and debit card transactions. It has given minus 12.5% return to year to date, and over the last year, it has fallen almost 16%. But when you look at the last 5 years, it has given almost 183% returns. Mastercard has a nice growing uptrend of gross profit every year, and here we see a nice uptrend in the dividend per share also. It currently provides a very low dividend yield of 0.62%, but has a 5 year growth rate of 18%. So that low dividend should keep ticking higher and higher very soon. As per my calculations, MasterCard's fair price is $328. So that's where it currently is. And the growth rate is expected to be around 26% over the next 5 years. I feel with MasterCard foraying into the cryptocurrency future, it has good growth prospects, and one should look to invest into MasterCard if they see any more downturn in the price point. The fifth and final stock on our list is Visa, ticker symbol V. Visa, just like MasterCard, is responsible for most of our credit and debit card transactions. Year to date, Visa has fallen almost 12%, but the financials of the company look good. Here we see a nice uptrend in the dividend per share. Visa has a low dividend yield of 0.78%, but a very good 5 year growth rate of 17.9%. So that low dividend yield should keep on increasing at a much faster rate. Per my calculations, Visa's fair value is $200. So currently it is right around that mark, and I see it growing at 19% over the next 5 years. So those are the five technology stocks that I consider as fair value at this moment, and investors can consider buying into them at this point, or at least have them on their watch list, so that if there is any further dip in the prices, that will provide a much better buying opportunity. I hope you really liked this video and would really appreciate if you could click on that like and subscribe buttons so that YouTube can suggest this video to many more subscribers like you, and also click on that notification button so that you're informed of all such videos in the future. Thanks for watching. I'm not a financial advisor, and all the views and opinions that you would see on this channel are just for educational and informational purposes only. Everyone should do their own due diligence before investing their hard earned money. See you in the next video. Until then, let's try as much as we can to be financially healthy. Bye.